Hello traders, welcome to Coast Investment Software. In this video we'll be discussing an introductory on trading with DiNapoli Levels. So without further ado, let me quickly move on to the agenda for today. We'll be discussing some history, specifically on how the method of lagging and leading indicators was developed, as well as discussing each and every one of them. We'll also be looking at some real market examples, and then we'll be tying it all together. We'll be giving you what we might call the trade plan in a nutshell. So moving on to the history of how this method was developed, Joe DiNapoli, who is also known as the godfather of Fibonacci, developed this method over years of rigorous testing. He's been trading the markets for over 40 years, the S&P futures since inception, and he's also spoken all over the world in major financial capitals, also down here in South Africa. That's how I got to meet Joe and learn the method. And then also he wrote the book Trading with DiNapoli Levels, which has been translated into 7 languages and is on its 3rd edition. That's the foundation of this whole methodology. He's also done exhaustive investigations into displaced moving averages. He created proprietary indicators, specifically the oscillator and MACD predictor, and he did to Fibonacci what I like to call simplify. So we'll be talking about that later. All this makes him one of the most sought after experts in the trading world. So when I started trading back in 2000, I was looking at various indicators, and we'll be looking at that shortly, but the basic indicators didn't work. So in 2002 I read Trading with DiNapoli Levels, and a whole new world of trading opened up for me. I also attended a couple of seminars, standard seminars, advanced seminars with Joe, just sucking in any information I can get on this method, and it has revolutionized my trading. It has completely turned me around from a losing trader being a professional trader today. So obviously the big challenge would be the psychology managing yourself. But for this video we'll be just looking at our basic trading with DiNapoli Levels on an intro. Let me get down to the indicators. Those of you who've been trading for a while now might have heard of the concept of lagging indicators. If we look at that, we can see the couple of old type of lagging indicators. You've got moving averages, stochastics, you've got trend lines, opening direction, breakouts, MACD, and then a new concept to you might be displaced moving averages, MACD stochastic combination, and MACD predictor, which we'll be talking about, and then also failures. So for today we'll be focusing on the last 4. Displaced moving averages, the MACD stochastic combination, the MACD predictor, and failures. Now the big thing to understand about lagging indicators, they're derived after price movement. So they're not really predicting us much, but they're good at giving us context of what the market is, or the stance, the current, let's call it trend of the market or direction of the market. So let's look at the first one. This is a regular moving average, and over here you'll be seeing how the price just goes through this moving average. A lot of whipsaws and a difficult indicator to follow, and at the end of the move here where you see the Q, that's standing for quit, and usually when you don't have a strong or an indicator that's very good at capturing the trend, you might end up quitting before you see this big move. Now an easy way to fix that Joe discovered was just displacing the moving average forward in time. So you take this moving average and you just move it forward by a couple of periods forward in time. So let's look at that. There's the same moving average, just displaced forward in time. You can see less whipsaws. At the bottom here you'll have M, which stands for a little bit of money, and also you'll have confidence to be sticking with this indicator and capturing the big move. So that's the concept of a displaced moving average. Basically a simple moving average displaced forward in time, capturing trends a little bit better. And then moving on to the stochastic MACD combination. So what you have on this chart is you have a MACD, which is a slower indicator at the bottom, and you have the stochastic, which is quite a fast and a sensitive indicator at the bottom. Sorry, that one at the top, this one at the bottom. So if we zoom into this, you can see it more clearly, and you can see how slow the top indicator is and how fast and sensitive the bottom one is. So looking at that, we'll be trying to position ourselves by going against the weak or the fast indicator, the stochastic in this case. So when the MACD is in a buy, it's showing an uptrend over here, and this one going into a sell, that's where you'll be looking to get long the market on a specific support. A couple of more examples there, and going to the right you have a sell example where the market gave a nice rally on the weak indicator right into resistance, while the strong indicator remained in a sell. So that's the concept of a combination, using two indicators in combination with one another. And then moving on to the MACD predictor. Now this is an indicator Joe developed later in the 2000s. So what he basically did was he took the indicator at the bottom, the MACD, and he reversed engineered it to show the indicator on the price axis. So if we zoom in on this, you can see the indicator, it's giving us buy and sell signals. Where you have the sell signal, for example, down here is where you have the price cross the MACD predictor indicator. So let me just zoom in on that quickly. Also what you'll notice is the indicator is showing one period ahead of time. So it's giving us a value where the indicator will be changing into a buy. The bottom indicator, our MACD predictor, will be changing into a buy at this price level of 1949 tomorrow. So this is giving us it's changing the concept of a lagging indicator into a little bit of a leading indicator, giving us one period ahead of time where we might have a trend change. So this is quite a useful tool. I use it every day in my trading, and it has simplified the MACD quite a lot. It also gives you more real estate on the screen. You can take the MACD indicator off, and it gives you more real estate and a better clarity when trading. And then looking at failures, those of you who are familiar with patterns will know this is a head and shoulder pattern, and what might happen is you get a breakout from this head and shoulder right into Fibonacci support, and when it moves back onto the other side of the trend line, you have what we call a failure setup, which can be very powerful context. Remember, we're talking about context for trading using lagging indicators to get a feel of whether we want to be long or short the market. So failure is a very potent signal that can give us context of what to do in the market. And then just moving on then, so we've discussed displaced moving averages, which are good. We've discussed the stochastic MACD combination, which is a good indicator for giving us market context. We've discussed the MACD predictor, and we've discussed failures. These gives us a reason to be long or short the market. So now we'll be moving on to leading indicators, and we'll be looking at mostly two. Just trend lines can be a poor to fair kind of leading indicators, but the big ones that we'll be looking at, the two strong ones, would be the oscillator predictor, which Joe developed and then we'll also be looking at Fibonacci, which is an excellent leading indicator. So let's start up with the first one, which is the oscillator predictor. It's basically an oversold, overbought, oversold band where you have overbought on the top, oversold at the bottom. You can see over here to the left how it captured market swings, and it's also quite powerful when you use it in combination with your Fibonacci levels. Another thing about the oscillator predictor, with same as with the MACD predictor, is you have one period ahead of time overbought, oversold value. Now the difference between this one and other overbought, oversold indicators is this one is fixed. So the current value in the axis is fixed. It gives you a price level where the market is overbought or oversold, and then you can use that in your analysis. And then also it gives you ahead of time tomorrow's overbought and oversold, so that's also useful. And then moving on to Fibonacci. So why does it work? There's two main reasons for that. The first one, it's a statistical law of nature. You get this ratio of patterns in nature, in pine cones, sunflowers, a whole bunch of, or in nature overall. And then this law of nature just spills over into human nature as well. So fear and greed and the emotions of the masses drive these markets from one Fibonacci ratio to the next. And then obviously, because a lot of traders will be learning about Fibonacci and using it, it's kind of a self-fulfilling prophecy as well. So trading, monitoring and reacting to these measures is certainly also a reason why it starts to work. So looking at what we use, the Fibonacci numbers, you can see a whole bunch of numbers, and I've got good news for you, we don't use that. So I've talked about Joe simplifying Fibonacci. This is just one example. So if we move on, there's a whole bunch of tools. Which ones do we use? Well, we don't use any of these. So no arches, no circles, fans, time counts, regression or clusters. We're just keeping it very simple. Trading is already hard enough as it is. We don't need a lot of confusion. So let's look at what we use. Fibonacci ratios. Those of you who have looked at Fibonacci know it's you've got a whole bunch of ratios which can also in itself be confusing. So what do we use? We don't use the 0.9, we don't use the 1.6, 0.218, we don't use the 0.5, we only use the 0.382 and 0.618 on the retracement side. And then on expansions, we don't use 1.318, 1.5, 2.618. We only use the 38.2% retracement, 61.8% retracement. We use three expansions, the 0.618, the 1 and the 1.618 expansion. So you can see Joe has taken Fibonacci and really through rigorous research throughout what doesn't work and simplified it so that we can actually use it in trading. So let's talk about how we use Fibonacci retracement and expansion ratios. First of all, it's very important that you use, when drawing your retracement and expansions, you use the utmost extremes. So imagine point A the low, point B the high. You can almost imagine a line chart there. You want to be looking at using the utmost extremes from point A to point B when doing your measurement. So let's look at that. If we look at a down move, or let me use this one, an up move from point A to point B, you calculate 38.2% of that AB price move. You subtract the 38.2% from the high, and that's your 38.2% support, which we also call the F3. Then you do the same, AB move up, you calculate 61.8% of that, you subtract it from the high, that's your 0.618 retracement support, and we also call that the F5 support. Now obviously you can use it the same way when you have a down move. So let me just show that a little bit more clearly. At those ratios, the 0.382, 0.618 ratios, you'll have on the right hand side what we call support, on the left hand side what we call resistance, and on the support side you most certainly see more buyers than usual at these ratios, just the law of nature as we discussed and the self-fulfilling prophecy. So this is telling us ahead of time. It is a leading indicator. It's telling us ahead of time we'll have support at this ratio and this ratio. The market might actually pause there for a while, it might bounce depending on what the context is telling us, but at least this is useful information and we know it ahead of time. So looking at expansions, we have on the left hand side an ABC move down, and if we quickly look at that, if we want to do a projection down, we'll start out with 100%. So you take 100% of the AB move and you project that down from point C, and that gives you the OP. In this case that'll be a support. Then you also calculate 0.618 or 61.8% of the AB move, and you project that down from point C. That gives you the COP support, and same with the AB, you multiply that by 1.618 and you project that down from point C, and that gives us the XOP support. So the COP, OP, XOP stands for contracted objective point, and expanded objective point. In this case, on the left hand side you have 3 support levels. On the right hand side you have 3 expansion resistance levels. Again, this is telling us ahead of time where we'll have support and resistance or buyers and sellers in the market. Then looking at retracements, so we've talked about the basic high-low retracement. This is a more advanced analysis with what we call 2 reaction points, 1, 2, so you've got an up move with the market showing us a swing low here and the ultimate low at point 2. So if we zoom into this, you'll have, if you do a measurement from the F, which is the high, to A or point 2, which is the low, you'll have a 0.382 and a 0.618 F3 and F5 support going back. From the reaction point 1, you'll also have an F5 and an F3 or 38 and 61% retracement going back. And what you have here is you have an F5 and F3 in close proximity with one another, and that is what we call a confluence support. So confluence is a DiNapoli level. It's a strong support and much stronger than the normal retracement ratios, and that's where we like to act on whatever the market is telling us. So if we want to be buying, that's specifically a good support that we want to be buying. Looking at lineage markings, that's the arches over here. It just shows us from which reaction point the F5 and F3 support is calculated, and different reaction points, which is point 1 and 2, etc., will give you different strength fib nodes, or 38 and 61% support levels in this case. So we also want to be looking at the reaction number and how it looks to determine how strong these levels are, and that's where the lineage markings comes in to help us with that. Then just quickly looking at a market showing us a confluence support, which we just talked about. This is gold with the high back in 2013, I believe. The confluence support between 1227 and 1155. Now remember, we knew about the support ahead of time when the high formed back in 2011 or 2012, and when the market got down there, we had almost 2 years of consolidation. Just look at this weekly chart getting down to that big support. So this is very useful information. I mean, if you know about this big support zone ahead of time, it gives you plenty of reason to do a trade, or even if you're short the market, get out of a trade. And we knew this ahead of time. Moving on to a advanced Fibonacci analysis with 3 reactions. So same as the previous example, A, B moved up, and then 3 reaction numbers. You have these multiple swings, and what this gives us just is it gives us 6 fib nodes with different 0.38 and 0.61 ratios, and also because you have 2 of these in close proximity of one another, you also have 2 confluence zones. So you have the first confluence a little bit up there, and the second one down here. So you have 2 strong support levels, or DiNapoli levels. So this again gives us good reasons to do a trade if the context is supporting to buy the market. And then just and finally we'll be looking at agreement. So agreement is where you have an up move, let's say like this. You have F3 and F5 support levels, but you also have an ABC move down, which gives you, of course we talked about that, a COP, OP and XOP projecting down. So agreement in this case is where you have an F3 and an expansion, or an F5 and an expansion in close proximity with one another. So that's agreement, and in the lower case we have confluence agreement, which is your strongest support. Again, these levels are projected ahead of time. It gives us good levels to know about for future use when the market is sitting up here where point C is currently. So why do we use this retrace tool with the lineage and all that? I don't even have to zoom in on this chart to just show you how messy the normal retrace tool is, but let me just zoom in for clarity's sake, or showing just how messy this chart is. And also, let's say the market makes a here, you have to pick every one of these retracements and drag it down, because we're measuring from the utmost low to the utmost high. We're measuring different swings, so this is very, very messy. So what Joe has done is, with this retracement tool of his, he's pushed it all the way to the right. He's taken out the levels we don't use, and it just gives us clarity. Just look at how easily you can see the confluence zone between 1193 and 1207. So this gives us clarity, and as you know, in trading, clarity equals money. So you want to be able to use the tool. What this tool also does, it's very effective. Once a new low gets made, you'll see there's a little circle there at the bottom of that low. That circle will then jump into new lows. The ratios will adjust automatically, and this tool will move down as the market makes new lows. So you don't have to go and adjust anything. You can just monitor the market action. Then looking at some real market examples. I love gold. I'm South African. We have a lot of gold miners down here. So I always use gold as a good example. Joe also talked about this specifically in 2002 when he was down here in South Africa, and we'll be looking at that shortly. So going back to an expansion, you've got an A, B, C, COP, OP, XOP upwards, and that's giving us resistance. So if you look at gold back in 2002, you had an A, B, C, COP, OP, XOP going upwards. So that was telling us ahead of time, back in 2002, if and when gold ever gets to these levels, we'll have resistance in the market. So let's quickly see what happened. I'll be playing this video, and that's gonna be the summary of this this COP, OP, XOP that I've just shown in gold.
I'm speaking with Joe DiNapoli today, and we're taking a look at the gold market. Joe, what's going on?
A lot of interesting stuff is happening with gold. All the way back in 2002, I was doing a series of presentations in South Africa. At the time, gold was approximately 250, and I showed them some Fibonacci expansion levels, the first of which is the 729 area, and since gold was trading at the time at 252, I told them the first stopping point was 729, and they were pretty surprised about that. In the year 2006, approximately, we did hit the 729 level.
Now what are we going to see?
Well, if you can take a look down at the expansions, you get some idea at how I came up with these conclusions. What I do is a series of ABC expansions. It's expanded out by specific Fibonacci ratios. Gives you 3 different levels, COP, OP, XOP. So if you go to the gold chart, the next level after the COP at approximately 730 was in the 1026 area. After a year's consolidations at 728, we did reach the 1026 area, something that at the time I gave the presentation in South Africa was totally unheard of. And after we hit the 1026 area, we had quite a dramatic correction. Those are the 2 expansions that I predicted in 2002. And after we hit the 1026 area, actually we got as far as 1033, we had an absolutely massive correction all the way down to 904 within just a couple of days. So the stuff is working, and the stuff is working well.
What are we seeing now as the market has rallied over $1,400, it's pulled back to $1,200? What's the next big move?
All right, here it is. And now remember, I was making this prediction in 2002.
Yes.
1504. 1504 is the XOP of the entire move.
And what is SOP?
XOP is expanded objective point,
okay,
and it is controlled by the Fibonacci ratio of 1.618. Now, the interesting thing about this 1504 level, and believe me, I intend to get all over this trade. The interesting thing, however, is that this information has been out there now for many years. And when people see that the 729, 730 area was accurately hit, had a massive correction, people see that the 1026 area was hit, had a massive correction, now people are paying attention. And when people pay attention to a number, the market has a way of making sure that only a few people are right. So exactly how you play this 1504 area is going to be a bit tricky. Typically, markets will die a bit before the number, or they'll blow through the number and blow the shorts out before the eventual pullback.
So you're saying 1504, but how close is good enough for the Fibonacci retracement?
1504.
Okay, that's it.
No, I've been looking for this number a long time. I've made a lot of money in gold. I do very well in gold. It is a highly liquid market. It follows these techniques very well, and I think we're going to make it. And I think when we do get there, it could signal a bottom to the dollar. It could signal the end of the risk trade. It could signal a lot of things. So it could be a very important number for currencies and for a whole lot of markets, not just gold.
Joe, thanks.
Welcome.
You're watching the MoneyShow.com video network.
It's always good to hear Joe do these predictions and actually see them materialize. So let's go and look at what happened around that XOP and compare that to the predictions Joe did in this video that was recorded in November of 2010. So in this chart you'll see the expansion with the COP, the OP and the subsequent pullbacks from those levels. And this video was recorded on moneyshow.com just before we got up to this XOP. Now Joe mentioned that it's either going to turn just short of this level or it's going to blow through and squeeze the shorts out. So the reason for that is once a number becomes well advertised, and as Joe said, these levels were advertised back in 2002 and the market just did 2 tremendous corrections from the COP and OP. Now when too many traders get involved in a level, the market's got a way of making sure that only a few make money. So you can see clearly the blowout we did where the market blasted through the XOP, and it actually did what we call a railroad track reversal pattern. That's also discussed in Trading with DiNapoli Levels before we finally did our correction lower. So again, it just shows you the experience that Joe has got with these levels and just how well they work. So what about gold now? The old COP, OP, XOP is over. We did our pullback. A new one is formed, ABC, showing a COP at 2076. So this level was known back in 2014. So in this next video, I'll just show you at how the market moved up and what happened on that level. Now remember, it's a leading indicator. We knew about this level back in 2014. So let's quickly watch this video as I narrate the market action.
Looking at the gold market from where we left off, the market formed a new ABC with COP at 2076.2 on the yearly chart and started to break out after a few years, moving into that resistance zone, and then dropping to the monthly. We can see a new confluence developing at 1690. The market hanged around for a few months, then started to head down from the yearly COP towards that big monthly support, and then dropping to the daily. You can see the daily starting to develop a couple of reactions, which I'll narrate as we go. The market creating a new ABC up with a couple of resistance levels, confluence and agreement zones. The market respecting those as we go, creating new ones, another agreement, and forming support as we go, confluence forming, and you can see holding that, and a new ABC up forming, revisiting the 1808 zone before moving up to the next resistance levels, another confluence forming and holding the 1900 resistance, confluence still at 1856, and the market testing that, holding the agreement around 1897 before forming confluence agreement 1843 and moving lower.
This is a really good example of how the market responds to levels on different time frames. So the points to take home from this video is we knew about the COP back in 2014, and we had a big correction from that COP. We also knew about the monthly confluence, the 1690 area. So the market did a pullback from 2076, and it also did a strong bounce from 1690. We knew about the levels ahead of time, the COP specifically, and also when the COP got hit at the highs, we knew about the market showing support at 1690 before the market even got down to that level. So these levels can give you really good reasons to look for trades and what to expect in the market. So looking at our next real market example, we can see the market now, the S&P, and in the S&P you also have the ABC, COP, OP, XOP expansion going up. So that's again showing us the market with 3 resistance levels, and also let's just quickly then go and have a look at what the market did specifically at the XOP. Now this ABC was formed back in the big financial crisis of 2008, the low of 2009, so we knew about these levels again ahead of time. It blasted through the COP because of these highs and the stops. It paused exactly at the OP. Now let's look at what happened at the XOP.
The S&P weekly moving into that yearly XOP, we have a confluence forming from thrust F5 and trump F3, and that's the first decent support ahead of time. The market moving down, testing it and bouncing.
A good example of the Fibonacci levels working in different markets. So we knew about that XOP back in 2009. The market got up to that level, did a perfect pullback down to big confluence support, and again bouncing. So that's again showing the power of these levels as a leading indicator to give us ahead of time a heads up whether there's going to be support or resistance in the market. So we've looked at the different indicators and concepts. We've looked at lagging indicators and what they are. We've looked at leading indicators and what they are. Now the question is, how do you combine these in a way that work? So the long and the short of this is, and this is where we're tying it all together, is the trade plan in a nutshell is to buy dips in an uptrend. So you have your leading indicator, which gives you the areas that you want to buy, and you have your lagging indicator, which gives you the context, whether it's in an uptrend or a downtrend. Same with sell rallies in a downtrend. So if we quickly go and look at our MACD stochastic combination, in the top end you have, let's say, a strong MACD. The bottom you have the weak stochastic. The stochastic goes into a buy. The MACD remains in a sell. It gives you, so the strong indicator is telling us sell the market against resistance. You have your DiNapoli level. You sell the DiNapoli level. You wait for your weak indicator to turn into a sell. That gives you your A, B, C profit objective, let's say a COP or OP lower down. So that is the trade plan in a nutshell. Buy dips in an uptrend, sell rallies in a downtrend. So how do I get started in learning all of this? And this is a really good and important question. The first step would be to read the book. So you can buy the book from fibtrader.co.za. There's also a lot of different information of this whole method over there. The book and Immunome course would be your foundation. That's where all these concepts are taught, and Joe has gone through some really hard work to put it all together in a way that's really educational and even entertaining, if I might add to that. The Immunome course was a precursor to the book. It's also a really good educational course that you can buy. It gives you MP3s that you can listen while you go through the book that's written specifically for this course. Then also there's a DVD that Joe did specifically on equity markets with Merrick. And then you can also visit the DiNapoli Academy. You can look at the DLFF newsletter. That's a newsletter I release every week, and it gives signals, and also it gives really good educational material where you learn this. And then there's the seminars, which I cannot emphasize enough. We're looking at both a basic and a basic and a private seminar, where we go through these concepts to make sure that it's understood correctly. There is different ways that you can mess up this method, so it's really important to understand it well, and that's where these seminars come in, and I'm really personally very glad that I have attended these. Joe does these seminars, I do them as well, and we'll be releasing the schedule every now and then on the website, so make sure that you look at that. And then as you subscribe to any of the Fibonacci tools, the DiNapoli tools in different software packages, you also get access to the client forum, which has more than 20 years of questions and answers and discussions on markets, where you can also post questions. DiNapoli Expert will answer that, and also a really good educational place or bulletin where you can learn this method. So really, I cannot emphasize this enough. If you are interested in this method, that's your learning path. Don't take any shortcuts. Make sure you study the book, not only read it, study it a couple of times. Do everything you can. The markets has got a way to just take your money. So it's easier to first educate yourself to make sure that you don't just lose money for nothing in the markets. So really, this is a really important point I want to make is make sure you follow the recommended learning path, and you can contact any of us on the website if you're unsure about anything. So I really hope this video has done to explain a few of these concepts and show you just how powerful these indicators can be by looking at the markets ahead of time and knowing where and when to act. Feel free to contact us, as I mentioned, on the website, and hopefully I'll hear from you one of these days.